Good morning, good afternoon, and good evening, everyone. This is Joseph Trevisani for Worldwide Markets and FX Street. I'd like to welcome you to today's webinar. Commodities, Rout or Root, a little bit of alliteration there. One of the things that we're dealing with when it comes to the current financial markets, both currencies that we're used to, equities, interest rates, credits, and commodities, is the very odd behavior that we have seen by historical standards over the past 15 years. Degrees of speculation that never occurred in these markets in modern times. In modern times, of course, I mean really back to the Second World War. In a general sense, in a historical sense, markets are not just prone to bubbles and speculation. It would seem to be a permanent feature of the interaction between money, potential wealth, and humanity. These modern, if you want to call that modern, meaning post-Renaissance, as Renaissance as in 13th, 14th, 15th century Italy, and what started there, the revival of classical learning, which is what Renaissance actually means and meant to begin with. Speculative bubbles are an inherent feature. Stock market crashes, booms, and busts are inherent features of the system. And one feature of that, in a modern sense, was the great inflation. Let me, and I'll give you a good example of that one here. Okay, this is a chart of a number of things, but one of them is WTI and U.S. interest rates. This is Fed funds rate. The orange is Fed funds rate. In lieu of a long-term inflation chart, this will do. Why? Because the reason we have this huge bubble, that's what it is, bubble in interest rates in the late 80s, in the 80s and into the 90s, was to squeeze out the bubble of inflation. Remember, bubbles of various types, they aren't always the same, they always switch, are inherent, it seems, in the intersection of human greed and the capitalist system. Human desire for betterment and to have more things, let's put it that way. In a Freudian terms, fear of death, but we're not going to go there. So that inherent law of the capitalist system was witnessed here. The inflation bubble of the late 70s and the early 80s, caused, among other things, by Lyndon Johnson's willingness to prosecute the Vietnam War without paying for it. All of these things are well known to economic history. So if there's a law of, as I would call it, a law of bubbles, the permanent reoccurrence of bubbles in a capitalist system, there's also a law, which is not really a law, but one which likes to quote it as a law of unintended consequences. The monetary authorities in the 70s, I mean, I remember that time. I was a kid, but I remember it. And I remember my parents, who, my father was a machinist and my mother was a teacher, speaking a great deal about the problems for the family, for family budgets, created by the seemingly intractable inflation of the late 60s running all through the 70s. Richard Nixon president who's been in the news lately here in the United States, but we'll not discuss that, tried price controls, which of course didn't work. Price controls don't work on a capitalist system. They don't work on any system. The Romans tried it too. It didn't work either. And they had their own inflation problems. Theirs were related to debasing the money. Well, they debased the money in a physical sense. They reduced the amount of precious metals in their coinage. But guess what? It didn't work because everybody caught on really quickly. So people inflation started demanding more of them, and you had inflation. Well, inflation is nothing more than a debasing of the currency. It doesn't matter what the currency is. It doesn't matter how the currency is ordered. Ours is fiat money. Why is a dollar bill worth a dollar bill? Because we believe it is, not for any other reason. And you print more of them, and you get inflation, and you debase the money. One of the curiosities, which I've spoken about many times, of modern financial and central bank theory is that a stable rate of inflation means 2%. Well, if it's not going up or not going down, that is a stable rate. That means the rate is continually 2%. But that doesn't that doesn't mean prices are stable. Prices are inflating 2% a year. Stable prices means no inflation and no deflation. That's what stable price should mean. The modern, and I call it canard, that banking canard, that inflation, that an economy benefits from 2% inflation is not one that I buy. It is, however, one that is very beneficial to heavily indebted countries, which are now, at this point, almost all countries that exist anywhere around the world. What happens? Well, the inflation inflates away the debt. But that's another story. So the bubble of the 70s and the early 80s was inflation. A bubble, if whatever you want to call it, it's a bubble. It may not be the type of valuation bubble that we're used to, but it's a bubble. And so remember, we're dealing with two things here. The human systemic propensity for bubbles in a relatively free economic system, which is what capitalism is, which lets people order their own lives to a greater degree than other systems as they see fit, at least economic lives. And the law, which is not a law, but is always quoted as such, the law of unintended consequences. When these two things collide or intersect, you get a situation that was unintended, that was not planned. A result, or as another phrase goes, man proposes, God disposes. Things never quite work out the way you expect. So let's take a look at this chart and how that might apply to today's topic, commodities, rout, or root. I hope you'll forgive me for the very small and not terribly witty bit of alliteration there. So how did central banks, I mean, as I said, back in the 70s, I remember distinctly my parents being very worried about inflation, because if prices are rising 12% a year, and they were at some points, you are not keeping up. Your wages are not rising on 12% a year. Very few wages were indexed to inflation, which is itself a bad idea, because all that does is institutionalize inflation. It accepts inflation as a given, and therefore it just inflates your wages to agree with that, and you institutionalize, you permanently install inflation and its compensation. That's not a good idea. Richard Nixon, as I said, tried price controls. Guess what? That didn't work either. Scarcity and money supply determines prices, not government regulation. And they figured that out moderately quickly. And remember, Richard Nixon was a Republican, and he's the one who put in price controls. But that gives you an idea of the depth and the concern of politicians and the political system, responsive if at a delay to the voters in a democratic system, about inflation. I mean, Richard Nixon didn't have a stable economic advisors telling him that price controls are a good idea. Just about everybody, every economist said price controls are a bad idea. They won't work. They didn't work. But on the need to do something, the Nixon administration put them in effect anyway, which again tells you of the depth of concern both in the population and in the government over inflation and what to do with it. Okay, now that was 7 or 8 years. I think that was in 71 and 72. I'd have to check on that. But that was the attempt to deal with it. The eventual result was Paul Volcker, appointed by Jimmy Carter, by the way, not by Ronald Reagan, but given very strong backing for his very painful policy of this: taking the monetarist point of view and squeezing out inflation. And it worked. The chart of inflation looks very much like the chart of the Fed funds rate over the last, this actual chart goes back to 1970. By the way, of course, as usual, if anyone has any comments or questions or anything else, jokes, as I always ask for, please type them in to the chat, and I will see them. They'll be relayed to me, and we will deal with any topics you'd like. Okay. So the central bank response vis-a-vis Paul Volcker and the monetarists was to squeeze out inflation with high interest rates. And it worked. But as is usual with a successful tactic, it is then enlarged into a strategy. And that's what you have here. Central banks began inflation targeting. So one of the purposes of their policies began to get inflation down. And they have been remarkably successful. Look at this chart. That's why I put this trend line in here on the Fed funds rate. Now, since the Fed funds rate is a voluntary rate, meaning it's set by the Federal Reserve, but it is really a market response rate because it responds to what the Fed think inflation is going to do. The Fed has not been a tremendously great prognosticator of things. Certainly the current Fed is not. I'm going to put up another chart here just for, okay, this is the one I want. And I'm going to propose a theory of causality here that I don't have too much proof for. But this, looking at these charts, yes, over the past couple of days because I'm looking for an explanation for the very dramatic change. Now, I'm using WTI as a commodity proxy here. That's the purple line on this chart, because it's very difficult. Most commodities are futures contracts, originally from the Merck, and some of the NYMEX here in New York, and now ICE in London, of course. And a lot of them don't have the calculated rolling average, which gives you essentially a spot price going back, because contracts rise and fall, of course, as they approach their expiration, and their pricing is colored by the nature of the instrument being a short-term instrument. So I'm using WTI as a proxy for that, because WTI does have this rolling average, the generic, which goes back, as you can tell, I've got this one back to 1980, I think. No, this one's back to 1987. That's as far back as I could get the WTI rolling average, the generic average. So I was struck by the different slopes, the reverse slopes of these two intersecting charts. Is this Fed? Oh, this is the 10-year. Excuse me. I'm sorry. This is the 10-year. Good. The 10 years. I really forgot about that. The 10-year I'm using because the 10-year is more commercially has more commercial applications than the Fed funds rate. Although, and it gives you a little nicer chart because it gyrates clearly a market generated rather than a diktat generated one as the Fed funds is. Okay. So we have the left to right slope of interest rates. And remember, this is essentially this is the same slope as inflation, which was the bubble from the 70s. And the response, which is what we're talking about now, the central bank rate policy. And we have from left to right, not from left to right, in ascending slope, commodities, WTI as a representative here. This until 2001 was pretty much, actually 2004 into 2000, late 2000, early 2004, had been the cap on WTI, West Texas Intermediate, the American crude standard. And the Brent standard, which is the European standard, looks exactly like this, only the skew is a little bit higher. You basically transpose the chart up a few notches, and that's about it. So now this goes, I only have it back to 1988 here, but this goes back to the early 70s. I think I have it. Let me see if I have a WTI chart back to the 1970s. I think I do. Let's see, is this one? No, same problem. I can only get WTI back in the generic back to around 1980. Yeah, that was the problem with this one. So that's why I don't have a job. And of course, the point of that observation is that the first oil embargo when prices skyrocketed was in 1973 during the 73 Middle East War. And I don't have that on this chart. But from 1987 till 2004, a period of more than 20 years, a generation, half of our adult lives, oil was essentially capped at about $30 a barrel. A lot of gyrations, but it essentially capped at $30 a barrel. After that, it never went anywhere near, well, almost never near that level again. In fact, this is a longer-term chart, so it doesn't include the dip down to 20 or so, 29, I believe, because it was very short term in the WTI. But it's nowhere near back to that level that it was before. Something happened in this period right here. And that's what we're going to talk about from now, because the change, the intersection of this period right here from about, I would say about 2002 to about 2006 or 7 is the period where the commodity balance seems to have changed, where the commodities pricing gets completely out of line with supply and demand. The demand for oil did not shoot through the roof here. The pricing did, and through here as well. The pricing did. The two are different things. Because in a freely traded market, where participants participate by virtue of their choice, more and more participants going in the same direction on price, when their only real interest is trading profits, provides you a different kind of market, apparently, than one that is tied to supply and demand in production and use, production and utilization. So what was going on here? We have this long-term downtrend in interest rates and inflation. This is more or less the median of the period. It's about 5%. Okay? And what do we find here? And this is what struck me about this. When the interest rate on the 10-year dropped below for an extended period of time, and then permanently, it seems, below the 30-year average on this chart, what happened? Commodity pricing exploded. How are the two connected? That's a partially rhetorical question. I'll answer in a second. But I just want to make sure that everybody can see the period that I'm talking about here. Okay, this is, let me show you where this is. Okay, where's the 19th US? This is the US. This is the US 10-year. Okay, I want to show you where we are. My lights just flickered here. Wonder if it's that ransom virus. Just kidding. Okay, this is the 10-year. Okay, this is, I remember, as I said, the same as inflation looks just like this. This is the peak of squeezing out inflation, the Volcker peak of rates. I think we got 17% or 18% at one point. This is where you resume about 1988, just by the time the Reagan's last term ended, is where I'm running the other chart from. This peak right here is the beginning of that chart. Okay, so we're talking about this period here, a very steady, trending, ordered, organized, downward movement in interest rates. Okay, this is the chart I was using, the one I'm going to continue to use here because I want to show what this is. Okay, so that peak is right here. After the interest rate peak of the 70s and the 80s, squeezed out inflation, this is where that chart is starting. This is the organized section, a blow up of the organized section of the prior chart. So that's where we are with this. And this period, these 30 years or so, has about a 5% median rate on the 10-year. Meaning all these periods, see this is a this is a simple moving average for the period, and it ends up right here at the end, which gives you the rate for the period, the average rate for the period. So as the 10-year rate permanently moves below the 30-year median, think about 30 years in a human perspective. What does it mean? Well, it's traditionally a generation. What else does it mean? It's generally not quite the working life, but close to, put it this way, the working life of comprehension of your career for most people. Not many people are like Henry Kissinger, who get to live to their late 90s, retaining all their faculties, at least their mental faculties. And so they have a very long period of which to apply what they've learned and their principles for their career. This certainly applies to my career, although it's a little less, that by the time you fully appreciate what it is you're doing, I mean, I ended up chose to go on a trading desk right out of grad school, and my only background in business was running a taxi cab, and showed up in my tweed jacket, thought I was an English professor or something. And it took me about 5 years to really understand what was going on. And so that gives me about 20 years of more or less understanding my own business. It took me a while to learn. So the 30 years of this period is the period that decision makers in businesses and other areas are their horizon on their own knowledge and experience, put it that way. So Someone who's now out there in business might just remember the 87 crash, okay? But they're not largely going to remember, at least experientially, or they might, it's at the outside of it, let's say, the inflation of from a business point of view, the inflation of the 70s and how they were cured, or the response of the central banks. But another thing that they'll remember, investment professionals will remember and be measured against, this is where it's key, the historical standards of return. So if you are a investor, a money manager, the people who get involved in trading WTI, increasingly so, your parameters, your standards for how much money you want to make and be judged and be successful is one of historical importance. When you run a track record, you go back. When you run a market, Dow, NASDAQ, S&P, whatever you'd like, and you talk about return, that's the return that your performance will be judged against. And when interest rates, as they have been historically, except for post-2008, are higher, a larger portion of your responsibility, as for investing goes, can be put into instruments that are relatively safe, non-speculative, yet return a large portion of that average return that you're aiming at. And one way to look at the average return is to look at interest rates. It's to look at the 10-year chart. A 10-year U.S. Treasury, in this case, it is a 10-year U.S. Treasury, is a safe instrument. It's kind of the base for investment returns. Because without doing anything over this period here, remember 10 years though. So even you put in a 10-year in here or here, it runs out here, and then you got to reinvest. But at any rate, take the 10-year as a safe performance standard. And the median over this period is 5% or so. So that is median here, but it's also median here in the institutional memory, if you will, meaning investment advisors, professionals, are still going to be looking to perform along the lines of the historical averages. It takes time for that to change. So here, right, investment professionals in this period here are looking back this way for return, for historical return. The period here, say 2004, when this breaks above the old level WTI right here, 2004, the average return on the 10-year was somewhere around 7.5%. That's the reference at that point. But here you have the real 10-year breaking well below 5. How are you going to make up that difference? One of the unintended consequences of this interest rate targeting by the central banks, of the success in bringing down inflation, was to institute and promote, in fact, institutionalize practically, a search for yield by all sorts of trading markets. The people here in 2004 in 2003, looking at the returns and looking at the historicals, need return. The markets are no longer able to get the returns that they're referencing historically by parking a good portion of by giving up basically this gap. Well, look what happens to the gap. Look at the gap here. If you just measure a gap between the actual rate and just say this is the performance rate. It's not, but you can use it as a proxy. Look how the gap widens out as the rates go down. That's a gap that has to be made up by the markets. And the response has been uniformly in many markets, the pursuit of yield. I don't have the equities up there, but the equities don't look that different than this chart. All markets have seen a very rapid increase in the amount of people participating in the markets for trading profits to boost that yield. This reference to bring this up to this. There is nothing in the response. Now, there are other factors here that I'm going to talk about in a second. They're the factors that psychologically and analytically enabled people to look at the future and say, this is going to happen. Of course it didn't, but at the time it seemed plausible. Remember the quote I've used before? Stock prices have reached a new and permanently high plateau. Somewhere about 1928, some very famous person said that, whom I have forgotten, and I'm not going to look it up. An economist. It, of course, wasn't true. You will always find the ready application of wishful logic to market situations that people are promoting. Okay, that's very understandable. So the pursuit of yield brought on by the ever declining return levels is one of the things that sponsored the huge run up in all. And this isn't only, I could use the Bloomberg Commodities Index, and it would produce exactly the same graph. It's just that the WTI goes back farther. That's why I used it. Now, one of the things that I think will change is that as time goes on and rates stay low, I mean, I don't see any indication anywhere in any financial markets or anywhere else that you're going to get a return that this graph over the next 30 years is going to turn around and go this way. It doesn't seem to be the case. You never know. It doesn't seem to be the case now. So the people here, remember here, 2004, who are referencing return are referencing this. Well, people now in 2017 are referencing this. So the expectations are different. The expectations of return into the markets are becoming normalized to the current situation. But right here, they were not. Remember, this is the era of the housing bubble as well. More pursuit of yield. How does this apply to commodities? Well, if markets, financial markets, are pursuing yield and ramping up the price levels, what happened in housing? Exactly the same thing, pursuit of yield. It's a more traditional type of bubble, but it's a bubble nonetheless. And what happened in commodities? Exactly the same thing. Prospective profits and the need to invest. You know, if your choice of investments, if you're sitting on retained capital or profits, and you're looking at a commodity chart that looks like that purple, and you're a resource company, what do you think? And there's one factor behind it which makes it all plausible. And what is that factor? Well, that factor is exemplified, although it's certainly not the only instance of it, of the ever-increasing supposed utilization of resources by the billion and plus Chinese who are just coming on the market after the capitalization of their economy. I mean, capitalization as in capitalism. So you have rates falling below the median. You have an inability in this period right here. You have an inability to make a large portion of your portfolio return oriented and relatively risk-free by investing in 10 years, if you will, at 5%. You have markets and pursuing yield. You could call this whole period the frantic pursuit of yield. Return, basically. It doesn't have to be yield. Yield applies specifically to debt instruments. But just return on your investment. And you have the enabling psychology of China, who will never stop growing, whose billion-plus people are all about to become rabid capitalists, and who will forever need ever-increasing amounts of resources. And you put those things together, and you have this bubble in resources. But the bubble has real-world consequences. Just as the housing bubble of 2004, 3, 4, 5, and into 6 had real-world consequences. What were those? An enormous amount of overbuilding. An enormous amount of speculative building and speculative purchasing on credit of housing. The overbuilding in the American housing market of that period went. Now, housing is a market which has cycled through booms and busts historically, certainly since the Second World War. But the amount of overbuilding in that period was, one, well beyond anything that had ever been seen before in a boom and bust cycle typical market. And it also accounts for, in many ways, the lack of building since then. Well, a lot of companies went out of business. A lot of companies got burned. You know, we travel out Long Island very often in the summertime and throughout the year. And at one of the exits on the where we change highways, there was a large field which had a big sign up in 2007 about a new development. And 1 or 2 houses were built. And then the crash. And the field was fallow for almost the next 10 years. Because we pass this 50 times a year. It has recently, within the past year, commenced building again. So this tells you what the excesses of the housing bubble produced. And that is emblematic, but representative of the same type of overbuilding, of over-resource building that took place in the commodities markets. What are one of the things that sponsored the investment and the discovery and the utilization and the technical abilities of shale oil and fracking? Well, it's high prices. What did the Australian ore producers do throughout this period here? Well, they expanded their iron ore, expanded their productive capacity. And this is true for all of the resources. So one of the unintended consequences, and I don't think, the bureaucracies, when they change direction and goals, are, the old ocean liner analogy. It takes a long time to get them moving, and when they finally do, it's very difficult to change anything again. And so the adoption, of inflation targeting by the central banks as a narrow focus that lower inflation is a good thing was never taken to the logical conclusion. How low? And just as an inflation psychology, ever higher prices is something that central banks were forever going on about, so is the opposite. And it doesn't seem that the question was ever asked, is an always lower, at least for most of this period, inflation rate a good thing? If our policies have been designed to lower inflation, how low, to what level, and how do we reverse? In addition, what are we doing by lowering the return of all markets? Well, we are turning, and we did turn many firms, financial firms, to pursuit of yield. And for the period I mentioned from 2000 to 2004, 5, 6, 7, we turned industrial firms, resource firms, to the enhancement of their productive capacities. And what is the result on the productive resource side of expanding capacities in oil and all other commodities? Well, the result is lower prices. I could do this with food charts as well, but it would be a very different, the price of food. The average family here in the United States now spends, 10% of its income, something very, very small, on food. I mean, if you live in Manhattan, you go out to restaurants a lot, it'll be a lot more. But the interesting historical change is that over the past 3 generations, past 100 years, say, the percentage of a family's income that is spent on food has gone down dramatically. For maybe something like 50%, I don't know the exact numbers, but it's gone down by a many factor. That is the same technological development that is playing out now in a much more concentrated fashion in resource and commodity pricing. See, the interesting difference between the two is with food. Actually, there's not that, now that I think about it, I'm reassessing, there's not that much different. Because the amount of arable land is essentially a limited resource. The amount of arable land with good growing climate is an even more limited resource. And it's only resources and technology that can expand that. What's the difference? Remember, we should all remember back in the 70s, the greening, population bomb and all those other apocalyptic books that the world was going to, by 1980, everybody will be starving to death everywhere in the world, and there'll be resource and food riots. Of course, none of this ever happened. The analogy to the peak oil nonsense of about 10 years ago is exactly the same. Technology provided the answer. The world was supposed to be in food riots with a population of 3 billion. It's now a population of 7 plus, and there are no food riots. In fact, people are better fed in more areas of the world, including emerging markets and poor countries, than they are anywhere else except probably Venezuela. But enough said about that. And that is not a technology issue. At any rate, the application of technology has resulted in a dramatic reduction and dramatic in food prices and dramatic expansion in the quality of foodstuffs available globally. Peak oil brought on which is supposed to be a very limited resource. We're supposed to be running out of it 10 years ago already, or 20 years ago. It never happened. There is a tremendous amount of resources out there that the technology has provided. So the era of booming across the board commodity prices is not one that has been, the view of it always, that's often taken, the peak oil view, is that it's the depletion of scarce resources that will inevitably drive their prices higher. And that we are entering into a world of permanent scarcity. This is linear thinking and linear projection at the worst. It assumes that current trends, the future can be described by simply taking a linear projection of current trends. And if there is any type of futurology that we should know by experience is wrong, it's that. The system is not, the future is not a linear projection of the present in any fashion whatsoever, and certainly not where technology is applied. So the commodity boom is, and appears to me to have been, much more a production, the result of specific trends in financial markets than any empirically determined supply and demand question. Now, does this mean that there aren't elements that, say, rare earth elements that go into all the electronics that do have a finite supply? Essentially, just as a logical fact, since we are on a finite world, the supply of everything that's on it is finite. There is only a certain amount of platinum or iridium on planet Earth. Whether that supply is also finite in the practical sense is a different story, and we don't know the answer to that. The supply of oil was assumed to be finite in a practical sense a long time ago at peak oil's theory, and it turned out to be completely untrue. It may be that this is also true for items which are now viewed as severely constrained in their supply. There is, of course, one other issue. We don't know how much of this stuff is on the moon. We don't know how much of this stuff is on Mars. We don't know how much of this stuff is in the asteroid belt or anywhere else in the solar system, which I would say from the Martian orbit in is now technologically accessible, even if we haven't decided to do it. Or the market forces have not driven us to do so yet. But it is certainly true that the view of resources as permanently constricted is one that needs to be revised drastically. After all, you have the empiricism telling you it's not true. And so when we look at the commodities space going forward, and we go back to the title, Rout or Root. The history that we're looking at is telling us a couple of things. One, look at this chart, that the commodity boom, I think, has been a product of specific circumstances. One of which we haven't even spoken about in pricing, of course, is simply the long-term effect of inflation. And even at the success of the government's central banks in reducing inflation, and I'm going to give them credit for that because I think it's due to a lot of their administrations. So there's an inflation factor over a long period, 30, 40 years, in any pricing. 2% a year is a fifth over 10 years. It's 50% over 50 years, right? Over 25 years, sorry. So the natural tendency of prices is to rise. And so when you look at prices and see them higher, it's not because anything has really changed, it's just the numbers are changing. But the pricing on commodities that we've seen in the past 15, 16, 17 years has been a function of specific market-based and somewhat psychology-based factors. It is not a supply and demand story. So it is not the advent, and it hasn't proven to be, of permanently higher commodities prices. If there's a supply restriction coming in that's going to force commodity prices higher, we haven't hit it. And as I said, even on a finite world like the Earth, we don't know the extent. And we also don't know, one, what's available on the ocean floor, and two, what's available in the solar system. So the likelihood of there being a permanent supply restriction, even in our chemically based energy culture, energy world we have now, our world is essentially is chemically based. We get the vast majority of our energy from fire. The line from, Neanderthal and Cro-Magnon using fire to cook to going to Tokyo on a 787 is not really as long and as far as you think. It's certainly not very far as time go. It's 5,000 years. 5,000 years is peanuts. Peanuts. I think Mohenjo-Daro and some of the earliest urban centers go back about 3,000, even stretch it to 4,000 BC. Okay? Add that to our current 2,000 and be generous, and you've got 7,000 years. So we are, and even be more generous, we are 10,000 years from stone tools and fire to a 787. In the history of the universe, that's, whatever analogy it is, it's very small. So our using these very short periods of time to make long-term judgments is a very seductive, but a very error-ridden way of looking at the future. And so for commodities, it is much more rout than root. The change in the commodity market in the past 15 years, the huge bubble and then the huge deflation, is probably tied, like the housing bubble, to this cross of these investment lines, the search for yield. And those in the commodity space, those resource developments, those techniques, that technology is not going away. What would make, say, for the next 10 years, U.S. shale drillers give up, go home, and not try and make money? I can't think of anything except oil at $20 a barrel. There aren't going to be any market forces, because at $45 and $50 a barrel, where it is hovering around now, almost all of these shale producers are now profitable. So what would keep them from making money? So the boom returned its investment. The old cliche, the cure for high prices is high prices, when it comes to commodities, has turned out to be true. And I don't see the specific requirements of this bubble period coming to the fore anytime soon. Markets are now used to much lower permanent yields. Chasing bubbles produces bubbles. Chasing yield produces bubbles. And it produces technology. China may keep growing, but it's never going to provide the demand for $150 oil. So the items that went into that long bubble, which became exacerbated right here but just before the financial crash, are just that. They are specific, time-related, market-related factors that drove commodities to that level, and they are unlikely to be repeated. Okay, folks, I thank you very much for attending. I hope this has been useful. This webinar will go up later on today. If anybody came in late, on the FX Street site and on our WW Worldwide Markets YouTube sites, you'll be able to listen to it again there. We will, of course, be running a webinar again next week, and I hope to see you all there again. Everyone take care. Anyone has any questions or comments, I will put my email address up there and you can address them to me and I'll be glad to answer. Thank you very much, and everyone have a good day.